Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 19th. What do we have this week? What do we see that we like? What do we see that we're concerned about? First off, for a week that on paper is plus or minus a point and a half in the indexes, it sure had a lot of volatility, right? We had some rips and dips in both the stronger areas, which have been value, small caps, mid caps, and the weaker areas, large cap growth, specifically technology. They're still trying to get some pricing done in here. What is a fair level for the NASDAQ 100 with its growth rates where they are, facing perhaps some elevated valuations? Market's just trying to find that level day to day. Some of the hotter areas, value, which we talked about, energy and banks, a big part of that value index. Small cap, mid cap, they've had great runs in here. Have they gotten to a level now where most of the short-term demand is in the names? We're going to find that out. Sometimes your best trade is patience. That's where it feels like to me, and from a trading standpoint and a level standpoint, it feels like we're at. We've got to let some of this play out. We've got to let that 10-year get priced in. We've got to let that 30-year get priced in. You know, a move from 70 basis points in the 10-year to 172 basis points today in a 6-month span, that is an awful lot for the equity market to have to price in. It's absolutely normal that we're seeing this volatility day to day and week to week, even if the indexes are masking some of that volatility. Good rotation in sectors. What worked yesterday doesn't work today. What works today didn't work 3 days ago. That's the hallmark of a market trying to get their different sectors, different industries priced in. And we last spoke about that last spring, right? With COVID. Tremendous volatility. All volatility is buyers and sellers fighting over price, trying to get the worst case scenario priced into the market. Flip side is the best case scenario. Are we pricing in a best case scenario now in some of these sectors and industries that have had a real strong rip? So again, patience here. We'll let that 172, 173 in the 10-year work itself through the equity market. Sometimes that short-term fear of higher rates and inflation that affects growth names is exactly that, short-term. If we look historically, higher rates and inflation weren't the boogeyman for growth. We start to get to a point where elevated rates become interesting versus dividend names. At what point does the bond market start to pull equity money? Doesn't feel like it's here. Don't forget, we're at a 2% 10-year 16 months ago. So we're only approaching areas we were pre-COVID. We'll see what it takes to get money coming out of equities into bonds. Not there yet. Have a great weekend. We'll speak again next week.
Good afternoon. I'm John Mousseau. I am the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon on March 19th. Another week of bond yields moving up. 10-year Treasury bond went from a 163 to a 172, up 9 ticks. The 30-year bond from a 238 to a 244, up 6 ticks. Muni bonds really got a little bit of a comeuppance this week. We saw the 10-year AAA scale go from a 102 to a 116, up 14 ticks. So some of this is just the municipal market, which was so crazy, starting to catch up a little bit and yields moving higher there. Are we worried about this? Not really. A couple of things. Number one, this is a return to normalcy. Those of you who are remember their history books, remember that was a phrase that Warren Harding used in 1920 when he was running for president. Return to normalcy, return to an economy like it was before World War I and the pandemic of 1918 with the Spanish flu. There's a little bit of that going on here now. We saw this from the stimulus announced last week that Congress passed. We're seeing it in the steepness of the 2 to 10-year yield curve. Continues to get steeper. Hasn't been this steep since 2015. What does that tell us? That tells us that the markets are expecting economic activity coming out of this. So this is a return to normalcy that we have been expecting for a while. It is one of the reasons we are somewhat defensively positioned coming into this. We think there's still more room to go, although one of the things you watch now is the fact that the 10-year Treasury bond yield now is producing a positive return over inflation of 0.2 to 0.3. That's not that much, but the fact that it was negative by over 1% just at the end of last summer tells you the turnaround that we're seeing. We don't think this necessarily causes that much consternation for stocks yet. Maybe some backing and filling, etc. But remember, the 10-year bond is still lower than it was at the beginning of 2020 at a 190. So do we expect it to get back there? Yeah, absolutely. More of the return to normalcy. The Fed this week says, hey, we're on hold. They want to make sure that people understand they are not going to embark on anything until they see the economy in good shape. Jay Powell is going out of his way to tell people that. We think that he'll probably continue that message for a while. So we expect to see still more movement up in rates, but maybe at a slower rate moving, now that we've gotten off the floor where we were. As we go forward, what we really think is that people need to concentrate on credit, being very careful on credit, particularly in the municipal area as you come out of the mess. Some municipalities are going to be a little more constrained than others just because they've gone through this tough period. Yes, they're going to get some stimulus money, but we're being very careful. And most importantly, as everybody goes into the weekend, we hope you're enjoying March Madness. It is my favorite sporting event, and I think the fact that we are back having it after 2 years, albeit with small crowds, is one more sign that we are in a return to normalcy. Enjoy the weekend.